Good evening, ladies and gentlemen. Very warm welcome to one and all, both from our SIAS members who have logged in through the Zoom link, as well as participants from using the Mumu Live service. So we've got a great lineup today. We've got Raphael Lim, Associate Director from the Research and FinLit Financial Literacy group from SGX. As well as Mr. Rahul Rana, CEO, as well as Ms. Cindy Teo, CFO from Prime US REIT, joining us today. So what we're going to do today is to have Raphael go through the highlights of the STI index, and he's going to let us know beforehand whether he's going to get a big fat bonus because the STI index has hit 4,000 points. And whether there are any job openings. Then after that, we're going to have a presentation by Prime US REIT to talk about the expansion growth plans, the dividend policy, as well as some of the risk factors surrounding US property right now. And then we're going to open up the session to the floor. So do you have, if you have got any questions that you like to ask, you can use the chat function in Zoom. For people on Mumu Live, you will have to use the Zoom link to log in before posting your question. Okay, so without much further ado, I'm going to introduce Raphael Lim, Associate Director, Research, as well as Financial Literacy Department from SGX Group, to talk about the latest market updates on the STI. So over to you, Raphael.
Thanks, Benjamin. Just let me share my screen first. So yes, good evening, everybody. Today I'll be sharing some of the highlights from the Singapore market in recent weeks, as well as a quick update and overview of how the REITs are performing so far this year. But before we dive into the presentation proper, just a quick disclaimer first. So the sharing today is for information purpose and should not be taken as investment advice. It's not an offer or solicitation to buy, sell, nor financial advice. And also past performance is also not indicative of future performance. So please take note of that. So with that, let's begin. So as Benjamin mentioned, looking at the STI performance, it's clear that the index has been on a strong run for the past year or so, which has been pushing the index to fresh all-time highs, beating the previous record that was set in October 2007. So for the first quarter of 2025, the STI has risen nearly 5%, continuing on the momentum that we have seen in 2024, where it had total return of above 20%. So last Friday, which was the last trading day of the first quarter, the STI actually broke past the 4,000 threshold for the first time, trading as high as 4,005.18, which is now the new all-time high for the index. So what has been driving the index higher? Well, banks certainly has been a contributor over the past year, given their heavy weight on the STI. And the banks were also among the gainers in Q1, but they are not the only ones that have done well in the past year or so. In fact, in 2024, we saw the banks rank among the top 5 in terms of total return in the STI, but in the 2025 year to date, for Q1, the trio were actually ranked outside the top 5 in terms of their price performance. So in Q1, the best performer on the STI was actually ST Engineering, which was the top gainer, and its share price has actually surged more than 45% to $6.79 as of last Friday. So the stock has seen significant analyst upgrades this year, with its target price rising by 36% from $5.02 to $6.85. And average daily turnover for the stock has also more than doubled from the 2024 levels. So it's been doing well because performance has been strong, and it's also announced a new dividend policy recently in March. Apart from ST Engineering, other stocks in the STI that have performed well as well include UOL and Sembcorp Industries. Both of these stocks are up around 15% for the year to date. We also see REITs starting to rally, and of the seven STI REITs, six are currently in the black for the year to date. And CapitaLand Integrated Commercial Trust currently also ranks among the top 10 performers on the STI. Now, in terms of institutional flows for the first quarter, the 30 STI stocks actually booked 1.6 billion of net insti outflows in the first quarter, accounting for the lion's share of insti outflows that we see across the entire Singapore market in Q1. Most of the net insti outflows actually came from the three STI banks as well as the S REITs segment. But in recent weeks, we have actually seen REITs receiving net institutional inflows. So I'll be touching more on the REIT segment in the coming slides. So looking at the next slide on REIT performance in Q1, we have actually seen some investor interest go back into REITs and a bit of a rebound in Q1. So as REITs were rallying in March, the IHS REIT index actually snapped a 5-month losing streak and it rose 4.9% for the month. The index saw some of its strongest weekly performances as well during the month. It's probably some of the best weekly performance since July last year. Now, what are some of the possible triggers for the positive sentiment for REITs? I think in March, we saw that some US inflation data actually came in below market expectations. Beyond that, there are also some concerns of whether the US economy might be slowing down, which may affect how the Fed approaches its rate cuts down the road. Beyond that, we also see a number of research analysts issuing more favorable comments on the REIT segment in recent weeks, with some highlighting that it may be worth looking at this segment as we approach inflection points in the rate cycle. So apart from the price movements, as you can see from the chart, there was the spike in performance in March. We can also see some of these trends play out in terms of institutional fund flows. So as I mentioned earlier in the previous slides, REITs actually have been one of the sectors that has seen net institutional outflows in the first quarter of 2025. For the whole quarter, there was around 380 million in terms of net institutional outflows. But actually, most of this came earlier in the quarter, as you can see from the chart below. In January and February, there was actually 450 million in terms of net insti outflows. But institutional investors were actually net buyers into S REITs in the month of March with over 71 million of net inflows. In previous weeks and months, we typically have seen insti investors being net sellers of REITs, while retail investors were the net buyers. So clearly, some of the sentiment has been moving a bit in March. And in fact, I think if you look at the chart, in the first 3 weeks of March, it was actually the first time in almost 6 months where there were back-to-back weeks of net insti inflows for the REIT segment. So moving more to a broad overview of Singapore's REIT market, just to share some of the resources that investors can use. The following slides are actually from SGX REIT chart book, which you can access on our website. It provides an overview of the REIT market in Singapore, how it compares to other asset classes, as well as how the individual REITs have been performing in the most recent reporting quarter. So this is the latest version that has been published just a couple of weeks back with data as of end February. And as you can see, Singapore's REIT and property trust is one of the largest in Asia, with around 40 trusts boasting a combined market cap of around 90 billion. The trusts make up about 10% of Singapore's overall listed stock market cap, and around a fifth of every dollar that changes hands in the Singapore market comes from the REIT segment. Now, the REITs that we have in Singapore are quite diversified in where they invest. In Singapore, about 16 of the trusts that we have exclusively invest in property assets outside of Singapore. So this includes Prime US REIT, which we have with us today, who will be sharing more later. We also have about half the trusts that invest both in Singapore and outside of Singapore, and the remaining 4 REITs invest purely in Singapore. So geographical diversification helps mitigate risk, and also it provides investors with exposure to different property markets globally. The trusts that we have also span across various property sub-segments, including industrial, hospitality, retail, office, specialized, and healthcare REITs, as well as diversified REITs. Diversified REITs are the most in terms of numbers. About 10 of our REITs are diversified REITs, and they hold exposure to either industrial and commercial and retail, or different types of assets, which provides investors the diversification some prefer. Now, in terms of the key statistics, in terms of how the REIT market has been performing, we have seen the FTSE ST REIT index deliver 10-year total return of 37%. And currently, the average gearing ratio of S REITs is 39.6%, which is well below the MAS regulated limit of 50%. And on average, most of our REITs are currently trading below their book value. So looking at the average distribution yield of the REIT sector as well, currently it's trading at about 6.9%, which is quite a compelling level when we compare it to other asset classes. For example, the STI trades at a dividend yield of under 5%. And many investors also prefer risk-free investments such as government bonds, T-bills, or Singapore savings bonds. These are currently yielding under 3%. So REITs are currently trading at quite a compelling spread to other instruments. So for more information on how on the REIT market, you can refer to our website for the S-REIT chart book to have details on how the REITs compare to other asset classes, as well as how the individual REITs are performing in terms of their dividend yield, their gearing, their valuation multiple. But beyond the numbers, I think it's also important to hear from the REIT managers on how their properties are performing operationally, as well as the outlook for their respective markets. So with that, I'm looking forward to hear more from Prime US REITs on the outlook and the performance of the US real estate market.
Well, thank you very much, Raphael. So sounds like the main drivers of hitting 4,000 points is basically the financials. Part of it is, of course, ST Engineering, and I read somewhere that ST Engineering's year-to-date performance beats out NVIDIA actually. And then you have got the REITs holding out the end with the slightly lower valuations and hence a higher distribution per unit. So pretty good news. All right, so it's more of a wider, broader market advance rather than just concentrated among the three banks. So always healthy. All right, thank you very much for that, Raphael. Okay, next section is that we're going to have a presentation by the CEO as well as CFO of Prime US REIT. So just a quick primer for those of you who are not familiar with this company. So Prime US REIT is listed on the main board of the Singapore Exchange. It's a well-diversified REIT holding stable income producing prime office assets in the US and offers direct exposure to a portfolio of 13 high-quality Class A freehold office properties located in 12 key US office markets. So Prime's portfolio has a total carrying value of 1.3 billion US dollars. And we are very grateful tonight to have the CEO of Prime US REIT, Mr. Rahul Rana, to go through the presentation, as well as Ms. Cindy Teo, CFO, to help us answer any questions that you may have. So very warm welcome, Mr. Rana. How are you?
I am well. Thank you. Thank you, Benjamin. Good morning, everyone. Really appreciate you all dialing in. My name is Rahul Rana, and I am the co-sponsor and CEO of Prime US REIT. As Benjamin mentioned, we have 13 buildings. Our AUM, based on the last valuation, is 1.35 billion. We have about 4.2 million of net lettable area. Our occupancy today is 80% and going higher. WALE is 4.4 years. And you can see on the right, we produce a highly diversified portfolio in terms of geography and tenants. The sponsors of the REIT is KBS Asia Partners, which I'm the managing partner of. It is an entity which has extensive management experience in commercial real estate and managed over 40 billion worth of real estate assets. So we are the sponsor of the REIT. Our strategic investor is Keppel, who I think most of you know, a global asset manager with about 65 billion under management. And also another investor is Cascadian, which is owned by Mapletree CLA, majority by Capital Land. So that's the sponsor group. I'd like to turn your attention to page 5 so we can get into the key highlights. So we are going to talk a little deeper about the US market, the leasing going on at Prime, and our financials. This is results as of December 2024. You see our leasing volume increase year on year by 17%. What's happening is because of the pandemic and interest rates, uncertainty, and banks, how should I say, their confusion on to lend or not to lend has created a supply constraint, meaning new construction is at an all-time low. Over the last couple of years, the return to office has gained momentum in a big way, and I'll cover that a little deeper in the next couple of slides. And one theme you will see me talk about is flight to quality. These 13 assets that we own are Class A assets, which are rich with amenities, great location, accessibility from transportation is excellent. There are great features of walkability, like walking to food courts, and we give a very good feel to our tenants that excites the employees to come back to work, and we'll go into more details later on. On the leasing front, occupancy is currently at 80%. We saw our leasing volume increase by 2%, and there's been a rental reversion of 1.8%, year on year. On our financials, we are proud to say that our valuation that came in from a third party was up 2.2%, which is a real validation on how our pipeline on our leasing is looking like. Also, the quality of our assets and the money we've spent in our buildings to make them bright and shiny, to continue to attract top branded tenants. That helped our leverage come down to 46.7. And last year, in the middle of last year, we completed a Herculean task of getting 550 million refinancing, which is also a validation of these global banks when they look deep into our portfolio. For them to refinance 2+1 year kind of refinancing for 550 million was a big validation on what we are doing. This 550 million has about 150 million of working capital line, which allows us to draw down and help facilitate tenant improvement and capital expenditure at the asset level. So on to page 6. Like I mentioned, our portfolio valuation up 2.2%, and this was primarily driven by our method of diversification and active management. How we choose to spend our dollars on asset enhancement as well as tenant improvement. So it's very prudent approach. It's very well calibrated and calculated. I mentioned we completed a $550 million financing in 2024. What that does is when we talk to a tenant that is looking to come into a building, especially tenants that are single A rated or above, that are looking for 100,000 square feet or above, these conversations take a while, take about 6 to 9 months to complete. We really spend a lot of time with these tenants. It's like a partnership. They look to sign 10-year leases, and we get really into the nitty-gritty of what the needs of the employees are, what kind of look and feel they need on their top 2 or 3 floors that they're taking, what kind of signage they would want on top of a building. So these conversations are very deep, involved, in today's world, the tenant is very interested in understanding what the balance sheet of the landlord, i.e. Prime US REIT, is. So of our refinancing that we did it has been a huge help and an impetus to go deeper into these conversations that we're having. And, we feel very confident that our occupancy levels are going to be higher this year and much higher next year. And we'll go into a little more detailing asset by asset in a second. I talked about flight to quality, transit-rich locations, credit-worthy tenants, and positive leasing momentum. So I'm going to turn it over to Cindy now, Cindy Chua, our CFO, and she's going to walk you through the next few slides, and then I'll jump back in later on.
Yeah, thank you, Rahul. Good evening, everyone. I'm Cindy, the CFO of Prime US REIT. Thank you for giving us your precious time today. So the key takeaway from this slide, you'll see that there is no refinancing needs for 2025. Before the start of 2024, the focus was on getting the refinancing done. We set very clear targets to manage down our leverage, and we delivered what we said we'll do. So to recap, first, we sold an asset at 3% discount and bring down the leverage to 46.7%, which is a good 2% point from where we were previously a year ago. And because of the leases we signed, cash flow projections used in the valuers model have more certainty, which improves our valuation and thereby helping us to bring down our leverage as well. So with the 550 million facility, we have a very comfortable headroom to the MAS 50% leverage limit, and we have 76 million liquidity to tap on to fund the capex. But we continue to be prudent in the capex spending. No doubt, the cost is more expensive given the interest rate environment we are in when the refinancing is done. We have removed the refinancing risk to be able to focus on the business, which is the leasing. So to give a quick snapshot and move on to slide 9 on the leasing summary. 592,000 square feet of leases was done in 2024. We achieved positive rental reversion of 1.8%. Occupancy improved for majority of the portfolio, and we are expecting big leases to be signed in 3 of our assets. And I'll move on to slide 10, which shows the occupancy. The committed occupancy of the portfolio, where we'll elaborate further for the assets that have not reached 90% occupancy. So the 101, it used to be called 101 South Henley, is located in Clayton, where we see much relocations from downtown St. Louis, such as Omicron Group, which we highlighted in November last year. We had done a lot of new leasing in 101. But this cash flow will only come in probably another 9 months or so. And with these new signings, extending the WALE, with greater certainty of the cash flow projections, we see double-digit increase in the valuation of this asset. Promenade. We had a known vacate, i.e. Apache, 70,000 square feet, which is approximately 30% of the NLA in the building, which we had backfilled most of it, and the value also recognized it, which is why the valuation were up 8% in 2024. But moving on to Tawan at Emeryville, things are still moving slowly, but the area is likely to be filled by biotech, AI sector. We see a deep, less than 1% drop in valuation. And for our Atlanta asset, which is at Atlantic Station, a very convenient location, there's a nice story where a new long-term tenant, extended and expanded their space with us for another 10 years. So this is actually good sign, good momentum where the tenants are moving. They are done with a downsizing and into right-sizing their space needs. Residence Square, our smallest asset, which is about 139,000 square feet of space in the portfolio. After the vacate of a major tenant of the building highlighted by a Business Times article in 2022, we completed the minor AI in 2023 and had moved occupancy in 2024 from 48% to 66%. Valuer recognized that and valuation increased with a longer WALE. Park Tower. To provide some updates on the big list that we have been talking about, it's true that such mega list finalization takes a long time because we are talking about more than 100,000 square feet. I mean, they are looking at larger space now, hence it's pushed out to likely in first half 2025, which is the second quarter. So unfortunately, this asset at Sacramento recorded the largest decline in valuation due to a recent asset sale by the peers transacted at a big discount to the 2023 valuation. So in a way, this has indirectly affected the cap rate used by the valuer. So for our Denver asset, VCS1, it is a slow submarket. Employees are still enjoying the remote working kind of arrangement, but things are changing. So we have received a handful of inquiries for relocations in the second half of last year into our building for employers who are trying to entice their employees to return to office. So lastly, our Washingtonian asset, the AI is completed and the prospects are here to see the new lobby and amenity center. The focus is on attracting credit-worthy tenants, but still we will be prudent with the CapEx spend. So all in all, we end the year with a 80% occupancy, committed occupancy. So I move on quickly to slide 11. This shows you the WALE. So despite the passage of time, our WALE wasn't shortened, but instead we extended the WALE of the portfolio. This tells you a lot in terms of the type of leases we sign in our assets. These are long-term partnerships with credit-worthy tenants. There are greater certainty, visibility of the longer-term cash flow coming in, which is also reflected in our valuation. So moving on quickly to slide 12, we have our top 10 tenant, pretty diversified industry with a WALE of 3.9 years. So now moving on to slide 14, we come to the financial results. Comparing to 2023, 2024 performance are not fantastic, but that's because this is almost the effect of the aftermath of the COVID-19, remote working, and of course the high interest rate macro factors since 2 years ago. The drop in DI is mainly due to the lower income from Washingtonian asset, which underwent the AVI for almost 3/4 of the year in 2024, and the divestment of One Town Center in middle of 2024 for leverage and liquidity management. And of course, also attributed to higher finance costs as compared to 2023. But we hope unit holders can be patient because the new leases that we signed in 2024, their cash flow will mostly kick in towards the end of 2025. So knowing the importance of distribution, we continue paying a 10% payout in the current challenging market. Move on to the next slide on balance sheet. With the increase in valuation that offset the CapEx spend, we maintain our NAV at 55 cents. But our share price took a hit and we have a more than 70% discount now, trading at 70% discount now to the December NAV of 55 cents. So the next slide, we are sharing some general market data, but we'd like to draw your attention to slide 18. So we share some references to the large corporates getting their employees to return to office, which this may not be new to you now. And over at slide 19 to 21, in the next few slides, we also share some market data on the leasing activity picking up and a reduction in supply. So all in all, it seems like we are at the inflection point and turning around. So lastly, I'm sharing what Brookfield and Blackstone is saying. US office market is bottoming out. So we are hopeful for our market. And now I'll hand back to Rahul to give a concluding statement. Rahul, please.
Thank you, Cindy. So just to pick up on what Cindy mentioned, she talked about our asset, which is 30 minutes away from Washington, D.C. We went through an asset re-enhancement We are in deep tenant conversations right now. In fact, I'm in the US, and we're hoping to bring some good news back to Singapore in a couple of months. We feel very confident based on our deep discussions and pipeline that our occupancy is going to look a lot better. We dropped to 80% because of the aftermath of people working from home and uncertainty in markets, but that trend has flipped. It's the return to office is a big theme with corporate America, and also both in the private and public sector, right? Elon Musk and Donald Trump are making heavy statements on people getting back to work, right? So I want to kind of just touch upon, we are very focused this year and will be till 2027, driving occupancy. We want to bring this back up to those 90 handle in the next couple of years. We talked about a massive flight to quality, and we are kind of lucky in that way because the quality of our assets are spectacular. When you see our buildings, they are wow factors, right? Our prudent approach to our balance sheet, how much we borrow from the banks to spend, how wisely we use our distributable income to bring in these larger tenants is where our skill set is. We continue to focus on leverage. We think the more prudently we spend and bring in tenants with longer leases, the better evaluation is going to be, and thereby our leverage will continue to get better and better. Our leverage continue to come down. We hope to start looking at acquisitions in the near term, and we are very, very focused on, and we take this very seriously, to talk more about our dividend and making it back to normal levels. With that, I would like to turn it over to Benjamin and see what kind of questions we can answer for all of you.
Okay, thank you very much, Rahul, as well as Cindy. That's very illuminating. Personally, I do not have much appreciation or understanding of the US office sector, so that was pretty educational for me. And I'm glad you touched on the dividend policy as you're ending your comments just now. So that is a good segue into our first pre-submitted question. So this person wrote in to ask whether or when the Prime US REIT is gonna resume full dividend payout. Is it gonna be in 2026 or earlier or after that?
Yeah, thank you, Benjamin. We like I mentioned, that's our top priority, to focus on getting dividends to where they belong, right? We this year, like you can tell, we are leasing, right? Getting our occupancy up. That helps our top line. We are prudently managing our cost of debt, which, given the uncertainty that tariffs are bringing in, what Donald Trump talks about Liberation Day, right? There's going to be a lot of excitement coming in the next, tomorrow, right?
Yeah.
You just saw the headlines today. Europe is going to retaliate, and so there's a lot of interest rate uncertainty. Our view is there will be near-term inflation, but that'll be one-time hit. It won't be a longer-term inflation trend. It could lead into a slowdown of the US economy. Some economists, and I'm not an economist, but some economists are saying that would be an impact of about 0.5% to 1% on US GDP. But how the other countries, what they call the dirty 15, I don't know who made up that phrase, they will be impacted a lot more. So there could be some recessionary fears coming. But in environments like this, when you have a REIT with well diversified in terms of geography and tenant, it's a good thing, because maybe not this year, but next year you would see interest rates coming down. I mean, if I were to really net down what is the method to the madness of Donald Trump? What is he trying to do? He's trying to address the trade deficit of the US, and he wants a dollar that is not too strong. And, the best way to manage trade deficit is to have lower rates. So I think there's some logic to this theory about interest rates could be a lot, how should I say, there will be an easing of rates in not in the near term, but at least in 2026. But having said that, it's our top line we're focused on, our cost of capital, maximizing distributable income. We made commitments on CapEx for our buildings for 2025 and 2020, first half of 2026. So, we are taking this very seriously in terms of our dividend payout to normal levels. And, we are striving towards that. Yes.
Okay. All right. So moving on to the next question. The price performance for Prime US REIT relative to other REITs listed on the XGX is not that strong. So I guess the person who wrote this question is wondering what you see is the main drivers in the relative underperformance compared to other REITs listed on SGX.
Yes, Benjamin. So our 13 assets are performing well, and those that were okay are going to be on a good track this year and next year, right? So from an operational standpoint, we are good and going to be better, and then this year and next year, right? There's a massive dislocation between the stock price and what's going on in our buildings. We're trading at like 70% discount to NAV, right? And I would say it's a combination of a few things. One is Asian investors reading headlines, US office market, and there's everything is kind of clubbed together. No one really kind of sits down and understands what this flight to quality means, right? So I think there's deep value here, right? And the second reason, of course, is because we are paying only 10% of our distributable income, and that would change, in 2026, coming into 2027. With that in mind, so there are obviously two types of investors that are income hungry, and some are total return based, right? So those that have a total return kind of longer term view should be buying this stock, right? And because it's a deep value, right? And if we remain very confident because we see what's going on in our buildings. All our assets are profitable, right? We have healthy cash flow, and it's going to get better and better. So the net drop is going to be better this year and the following year.
Okay. So I guess one of the factors driving the relative underperformance is really a lack of understanding or appreciation for the specific locations of your properties in the US. Because from a very human perspective, like me and my wife, we go out and look at show flats just for the heck of it, where the condo is. So of course we know that if the condo is at Tanglin, it's totally different from Jalan Eunos or Paya Lebar. But of course, if you tell me, and I saw all the addresses for your properties, and I have no idea where they are. But of course, one of your tenants is Goldman Sachs, and yeah, that's Goldman Sachs. It's not, Kanakao peanut butter coffee shop or something. So I guess that's one of the things, because the typical Singapore investor is doesn't quite understand what are the best locations in the US. So it could be that could be one of the reasons, apart from the financial so and so forth. Yeah.
Yeah. So Benjamin, the US real estate market is massive, right? So we are not in the big cities like New York, Chicago, Boston, Los Angeles. We are in what we call submarkets, right? Salt Lake City
Yep.
is the highest job growth kind of city in America, right? We are in Denver. We are in San Antonio, in Dallas, just outside Philadelphia, 30 minutes from Washington, D.C. These are all urban CBD kind areas. And, transportation is easy. We have parking facilities where people drive in, go into the building. If you see this building right in front called Crosspoint, it's considered one of the best assets in the Northeast. Right, this 550, this building that you see on screen. So, and the parking is on the left. You come in, it's a great feel. You walk in there. So, these things matter to employees that are coming back to the office, right? We interact. We have, beer Fridays. We have activities. Our property managers are engaged at a very personal level. We have a cafe where everyone kind of gets their nice cooked eggs in the morning. And, it's a very good feel. It's that kind of connection and partnership with tenants. It's what excites us. And we remain very hopeful for the future.
And I'm just guessing here, but from what I read in the news and the reports that have been coming out in the last few years, the high, I guess, so-called famous locations like New York City and LA, so on and so forth, those kind of offices kind of suffered quite a fair bit of lack of foot traffic as well as loss in value because of COVID, because people were working from home, so on and so forth. So from that angle, I'm guessing that the locations of your properties are perhaps not the names and locations where most of us will understand, but that's why we have people like you to kind of find out where the hidden gems are and to buy it and to invest in a fund so that we don't have to and we don't need to, and all we need to do is to make sure that we get in at the right price, for any particular REIT.
Yes, thanks, Benjamin. So, our submarket that we are in, we are the top player of real estate in these submarkets. There's no doubt, right? So let's say if you come to a city like New York City in Manhattan, if you look at the Park Avenue sector, right, from Grand Central up from 46th up to 60th, that's the best performing real estate market, office market in the world. Right? Each building is $1 billion, and they are all 100% occupied. You cannot get space. But 2 blocks over of the 3rd Avenue or Lexington, occupancies at 40%. Those are what we call Class B buildings, and game over for them. So Class A, Class B, big difference, right? So all that demand for offices coming to Class A. That's the point of our conversation, of our presentation. Flight to quality.
Mm.
If we had old buildings or Class B, it's a different conversation. Yeah.
Yep, sure. Just to add on to that, apart from the local knowledge of being able to select the right locations as well as to enter into long-term relationships with prospective clients, what would you say would be your management team's focus on enhancing shareholder value?
Well, many things, right? One is bring our occupancy, closer to that 90% number in a short period of time. We continue to focus on bringing dividend back to kind of normal levels, right? We continue to bring in and engage with branded tenants that enhances our diversity, and a prudent approach to capital management, our balance sheet, because cost of debt is a very important factor because it has a direct hit on distributable income, right? So a skill set of being able to hedge, not to hedge, what does the yield curve look like, what kind of swap strategies we're going to use. These are very deep skill sets that Prime possesses.
Okay. I think Cindy, she was singing your praises over there about the hedging as well as the interest rate monitoring. Okay. So jokes aside, let's move on to a different question. So there are, I guess, people like me, analysts and pundits out there who are saying that the real estate market in the US is facing a crisis never seen before. Well, I personally never made a statement, but the talking heads that you see on CNBC, so on and so forth. So what's your take on that kind of sentiment out there? Is the US real estate market going to fly off a cliff, or as you mentioned just on your presentation, that it has perhaps turned a corner?
Yes, for Class A office buildings, it's turned the corner. Not only has it turned the corner, it's begun to walk away in a fast pace.
Okay. So I guess the strategy right now of trying to lock in branded clients in long-term leasing contracts, that sounds like a fantastic strategy, because if the entire market is moving up and you get in the right people, they don't have any issues and their branded names, then that kind of lifts the profile of your entire portfolio, right?
Yes.
Okay, sounds good. We have got one more question from the pre-submitted bucket. And this is, I guess, an idea from one of our participants. Would Prime US REIT consider selling itself to a bigger fund or a bigger REIT?
Well, I mean, you see, once, so we are a very dynamic group that knows our submarkets very well. If it belongs to a larger REIT, I don't think it would, it's a tough question to answer. Question is, who owns the REIT? Who's the big REIT owner, right? So do they understand the US? Are they, is that a commitment that they're going to make in the US? So it's not an easy answer, right? But, I think what I would like to say is it's just a matter of time when we will see the stock price move. I mean, there are global players that are looking into the deep discounts, right, where there's dislocation, and that are looking for total return. I truly believe that in a period of time, we will resume acquisitions and growth and all the good stuff that a REIT should be doing, right? A REIT that doesn't grow is not a REIT, right? So that's the position we want to get into relatively quickly. Yeah.
Okay. And I think we've got time for one more question. And the question would be, would this be a right time for potential investors to look at Prime US REIT? Would you say that the current price point as listed on SGX would be a attractive price point to invest in Prime US REIT?
Well, we see it as deep value, right? Deep value, right? So those investors that are looking at total return, price appreciation, and then income combination, right? Those people should take a very close look at Prime.
Okay. Thank you very much for your candor as well as spending time with us, Mr. Rahul Rana, as well as Cindy Teo, CEO and CFO respectively of Prime US REIT. So we're grateful for your time with us today. For the participants on the call, and I can't just help, I just can't help it, but this is a learning point, right? So what you want to do is to kind of look at the financials as well as the catalyst factors involving any kind of investments, including Prime US REIT, and to look at the current price point and to decide whether or not that could be a good addition to your portfolio. So obviously the discount in terms of price to book relative to net asset value, as well as the estimated dividend yield or distributable income per unit at 6% is relatively high. I mean, for sure, it's much higher than the STI index in general, and it is even much higher than what you might get in the high yield bond. So considering the quality of the portfolio as well as the management team's track record, this could be a potential investment for your portfolio. But again, diversification is key. So, if you want to buy a little bit of the crazy stuff like NVIDIA, you want to buy a little bit of the not so crazy stuff like REITs, maybe buy a little bit of Singapore bonds, US Treasury, so on and so forth, just to kind of like diversify your systematic risk. All right. Okay. So if there are no questions, I think we've got one more minute. I don't see any questions on the chat. So going once, going twice, going 3 times. All right. Thank you very much, Mr. Rahul Rana and Cindy Teo, as well as Raphael Lim. Thank you so much for spending time with us. Really appreciate it on behalf of the retail investors, auntie, uncles from sunny Singapore. Have a great, I guess it's morning for you, Mr. Rana?
Yes, it's morning for me in the US. Correct. Thank you. Thank you, Benjamin. Thanks all. And I really appreciate everyone dialing in, and thank you for giving us the time to present our story.
Very appreciate your participation. All right. Thank you very much. Have a great evening, people.
Thank you very much.
Thank you.